So I'm going to talk for about 20 minutes on charitable giving, which is something that I've been doing since I was a teenager, and self-invested personal pension plans, which is how all of my pensions are arranged, basically, because I decided in my early 40s that if I was going to be poor in retirement, I wanted to have nobody to blame but myself. Tax itself is a very complicated subject, but I'm going to keep it quite simple, and I'm going to start by making sure that I cover the most basic tax rules. So I'm not assuming prior knowledge. I'm going to look at giving cash or shares, then go on to personal pension plans and talk about some planning that I've done personally before covering inheritance tax on your estate, something which I covered also in the Alumni Council meeting last year. And then we'll have Q&A. I spent my entire professional career worrying about the possibility of making mistakes and being sued, but when you're speaking for free, you accept no responsibility to anybody. However, the slides for this presentation are going to be freely available to everybody via Claire or indeed via my website, and I'm recording the presentation. And of course, feel free to take this material to your own tax advisor to check out what you want to do in relation to yourself. This is me. After 1 year as a teacher, I trained as an accountant, and then as soon as I qualified, I became a full-time tax specialist, and I did that until I retired. And most of what I write and present these days ends up being recorded and is on my website, where hopefully this presentation will end up as well. So just covering the most basic things, first of all, the rates of income tax, because everybody thinks that they know them, but they're not actually as straightforward as they look. 20%, 40%, 45%, everybody's heard of that. But the government never talks about the 60% tax rate that we have. Gordon Brown introduced a wheeze for stealth taxes, taking away your personal allowance once your income rises above £100,000 a year. For every extra £2 of income, you lose £1 of personal allowance. And the effect of that is like paying tax at 60% while those allowances are being taken away. The rates of capital gains tax vary and again are surprisingly complicated. It's 10% on most assets if you're a basic rate taxpayer, but only for that part of the gain which corresponds to your unused basic rate band, and then it's 20% as it is for higher rate taxpayers. But some assets suffer a tax at higher rates. The only asset I'm going to be talking about today is listed shares, where the tax rate is either 10% or 20% once you've exceeded your tax-free allowance. So let's look first of all at the simple process of giving cash or shares to charity. And for simplicity, I'm going to assume that the asset is company shares, and also I'm going to ignore the 12,300 exempt amount, just assume that you use that up otherwise. So giving cash. I've chosen to give £8,000 to charity because it makes the arithmetic easier to follow. And if you give £8,000 to charity, and if you're a taxpayer, the charity can claim a gift aid tax refund. So the charity ends up with £10,000 for your £8,000. So what does that £8,000 cost you? If you're, as you can see on this slide, if you're a basic rate taxpayer, the £8,000 costs you £8,000. But the charity's got 10, so there's something which I've called the benefit ratio. It's comparing what the charity gets to what it costs you. So the charity gets £1.25 for every pound that it costs you. A higher rate taxpayer will get some higher rate tax relief for making that gift. And either at 20, it's the difference between the basic rate of tax and the actual applicable higher rate of tax. And because of that, the cost to a higher rate taxpayer for giving that £8,000 is lower than £8,000, giving these higher benefit ratios. And 1.67 or 1.82, they're really quite noticeable. And this is, of course, has always been in the tax system to encourage people to give money to charity. You can also give shares to charity. But before looking at that, I want to look at the simple scenario where you've got some shares, they've got a built-in capital gain, and you sell them, pay the capital gains tax, and give the money that's left over to charity, which is actually a really dumb idea. Nobody should ever do this, but I want to illustrate the effect of what happens if you do it. So here we've got £10,000 worth of shares, cost you 2,000, built-in gain of 8,000. You sell them, you pay the tax on the gain, and you give the money that's left over to the charity. And you see at the very bottom, the benefit ratios are much worse than with a straightforward cash gift. And of course, the reason for those lower benefit ratios is you've paid capital gains tax. If you'd bought these shares yesterday, so they cost you 10,000, then you sold them, of course, you wouldn't pay any capital gains tax. The slide then would look just like giving £10,000 of money. So the moral is, if you're going to give something to charity, don't sell it first for cash and pay capital gains tax. Instead, give the shares directly to the charity. So if you'd given the £10,000 for the shares directly to the charity would have got them. The charity can sell them. Charities don't pay capital gains tax, so the charity gets £10,000. Giving shares to charity is not treated like being a taxable sale. There's no capital gains tax on giving things away to charity. There is capital gains tax, by the way, if you give things away to other people. So if you gave these shares to your best friends, it would be like a taxable sale, and you pay capital gains tax. And you get tax relief at your tax rate. So even the basic rate taxpayer here, giving the £10,000 worth of shares, gets £2,000 tax relief, 20%. And the benefit ratios on the bottom line are identical to the benefit ratios from the gift of cash that we talked about earlier. So moving on now to self-invested personal pension plans. First of all, the basic concept. You make contributions, there are very complicated limits, which I'm not going to talk about, and you get tax relief for making that contribution. The fund then grows, and it grows tax-free, and eventually you take benefits. And there are three kinds of benefits you can take. You can take up to 1/4 of the fund out tax-free as a lump sum if you want to. You can buy an annuity from within the fund, so an insurance company then pays you a fixed amount of money every year for life until you die. Or you can leave the money in the fund, invested whichever way you want it to be invested, and take out bits of pension as and when you feel like it, which is what I've done with my SIPPs. The tax-free lump sum is a pure giveaway from the government, the taxman, because you've had tax relief going in, it's grown tax-free, then 1/4 of it comes out tax-free. And this is monumentally generous as far as I'm concerned. I don't normally thank the government for being generous, but here it is very generous. And there's something called the lifetime allowance, which was introduced in the mid-2000s at the time when it was made possible to give much more money into pension schemes than you could before. And the basic concept is very straightforward. Is your SIPP too big? Is your pension too big? And the limit you're tested against is the lifetime allowance, and it's tested twice. The first time when you take something out of the SIPP, when you crystallize benefits. And again, and I was oblivious to this when the rules were first introduced. I woke up to it a couple of years after I retired. Fortunately, I woke up before I reached the age of 75, otherwise it might have been very painful. There's a test at age 75 which we're going to look at as well. And the lifetime allowance, when it was introduced back in the mid-2000s, was 1.5 million. The government then kept raising it until it decided it wanted to reduce it. And the lowest it got to was 1 million. It's now being indexed upwards. In all of the illustrations I'm going to use, I'm just going to use a flat 1 million to keep the arithmetic simple. So how does it work? First of all, let's look at what happens when you crystallize benefits. You take your SIPP, you compare it with the lifetime allowance. Is there any excess? If there is, You either pay tax at 55% on the excess, but you can then take the money out, or you pay tax at 25%, but the money stays in the SIPP and you still pay more tax when you take it out later. And after I left PricewaterhouseCoopers, I kept a close eye on my SIPPs, which were below the lifetime allowance, to make sure I didn't hit the lifetime allowance as share prices increased. But there's another test, again, when you get to the age of 75. So in this scenario, I got this same person who had his SIPP that was below the lifetime allowance originally. Now, when he actually crystallized benefits, his SIPP was only 800,000, the lifetime allowance was $1 million, so no problem there. He had £200,000 spare. He took his 25% tax-free lump sum and left the other 600,000 in the SIPP. So that's what he did when he crystallized benefits. He then gets to age 75, possibly 10 and 15 years later, depending upon when he first crystallized benefits. And he hasn't taken much pension out, so his SIPP has grown. It's grown from 600,000 to 1.4 million. And the test works as follows. You look at the original fund that was left over after the tax-free lump sum. You look at any unused lifetime allowance, so that doesn't disappear. Is the SIPP bigger than the combination of those two numbers? And here it is. It's 600,000 bigger. And again, you've got the same options. You pay tax at 55% and take the money out, or 25% and leave it in. But if you think about it, for this person to allow this to happen at age 75 is a complete and utter disaster. Because if he'd acted even the day before his 75th birthday and took a £600,000 pension payment, he would only have paid 45% tax on that, and he would have had the money post 45% tax. Now, if he takes the money, he pays 55% tax to have the same money. Total disaster. So I want to move on now to a simplified planning illustration, where we've got somebody who hasn't hit age 75, but the SIPP has grown and the SIPP is above the figure at which he'd be taxable. So if he hit 75 today, he'd have a taxable amount of £600,000. He's also got some shares, and for simplicity, I'm going to ignore any questions about the base cost on those shares. So what can he do to improve his position, making the assumption that he's got four goals? He wants to minimize his tax exposures when he gets to age 75. He does actually need money to spend, and he wants to give to charity while paying as little tax as possible. And very simplified, although it would work with smaller numbers, any other numbers, larger numbers, he takes a £100,000 pension payment in cash out of his SIPP. And that, of course, would be taxable at either 40% or 45%, depending upon his other income. But at the same time, he gives away £100,000 of his shares to charity. And he gets a tax deduction for giving the shares of £100,000, which means that he pays no tax on the pension payment. 100,000 in, 100,000 out, for tax purposes, tax nil. It doesn't matter if he pays some pay-as-you-earn. In fact, he will pay pay-as-you-earn when he takes the money out of the pension scheme, but all the pay-as-you-earn tax that's withheld will be paid back to him by the Inland Revenue as a refund once he sends in his tax return. So what does this achieve? The charity gets £100,000 worth of shares. He no longer has to worry about future capital gains tax on those shares. Yes, he's given the shares away, but he wanted to give money to charity. His pension fund is 100,000 smaller, so he's saved himself exposure to 55% tax on that number at age 75. He's got £100,000 to spend, and he hasn't paid any tax from doing this. there were other ways for this person to get £100,000 to spend. He could have sold some shares, paid capital gains tax, and left over £100,000 of spending money. But the charity wouldn't have got anything, and his exposure to high tax at age 75 on the pension fund would still be there unchanged. He could have taken £167,000 out of the pension fund, paid 40% tax. That's a big number. He would have had to spread that over several tax years to achieve it. But he'd still have these shares with a big built-in capital gain, and the charity wouldn't have anything. And as I said, it might take him several years to achieve doing this. So moving on now to inheritance tax. How does inheritance tax work? Again, basic principles. You look at your estate, value it. You deduct the nil rate band, which is $325,000. There's also some extra nil rate band you can get if you leave the house that you live in to your children, but that's taken away from you if your estate is too big. And because it complicates the arithmetic, if we illustrate it, while making no difference to any of the concepts, I'm going to ignore it today. So you work out your estate minus your nil rate band, and then you apply tax to it. So what's the rate of tax? It's 40%, flat 40%, but it's 36% if at least 10% of that taxable estate, the estate over the nil rate band, is left to charity. And that gives you the inheritance tax that you pay. And I illustrated this last year at the Alumni Council. Here's an estate of $425,000 picked to make the arithmetic easy. And on that estate, after knocking off the nil rate band, 40% tax, the children would inherit $385,000. Instead, what happens if you leave 10% of the taxable estate to charity? The taxable estate is £100,000, so you leave £10,000 to charity. The inheritance tax goes down to 36%, and your children's inheritance reduces after everything to $382,600. So they're down only $2,400, but charity's got £10,000. And that's a benefit ratio of 4.17. That's miles bigger than anything we've looked at so far in this presentation. And Andrew Stott raised a really interesting point when he saw a first draft of this presentation. Lots of people already plan to give money to charity or leave something to charity when they die. So what if they're planning to leave something but it's less than 10%? And the answer is that the more you originally intended to give to charity below 10%, the bigger the impact of going up to 10%. And just think for a moment if you were planning to give 9.99% to charity anyway, but you weren't planning to give 10%. The effect of giving just that tiny little bit extra to charity means that the tax on your estate goes from 40% to 36%. That's 4% of your estate extra for your children in this scenario where you were going to give 9.999% to charity anyway for nothing. So being a mathematician, I wanted to know what was the break-even point. And the answer is 4%. If you were planning to give 4% to charity anyway, going up to 10% costs your children absolutely nothing, as illustrated on this calculation here. If you were planning to give 5% to charity anyway and you go to 10%, the charity obviously gets twice as much, and your children are actually better off rather than worse off. It's quite mind-blowing. So that's all I wanted to say. The arithmetic, I'm confident, works, and you can check this out with your tax advisors. So I'll stop the screen sharing and go back to questions.